Hello, everybody. Welcome to the live stream. This is going to be about 30 minutes. Whoever joins, and we'll talk about whatever you guys want to. It's been, a few weeks since I've done a live stream, so I wanted to catch up, see if there was anything on your mind. So yeah, feel free to leave any questions in the chat, and if any of you are watching this after the fact, after the live stream, please post any comments below, and I'll try to get back to you if you have any specific question about anything. If you are watching this as the recorded VOD, then thanks for hopping on, watching this. I hope you find something interesting, learn something useful. Maybe not. That's what we're trying to do every day, though. But while I wait for people to hop on here, I can talk a little bit about some of the things that I have been, reading or learning about this past week or so. It might have been earlier this week or maybe the end of last week, actually. Ryan O'Connor of Crossroads Capital released a wonderful follow-up write-up on Nintendo. Now, Nintendo is a company that I've been following for quite some time, obviously as a consumer of the products for practically my entire life. But I had never really considered it as an investment until about a year ago. And I did end up making a very small investment in Nintendo, mostly due to Ryan O'Connor's write-up, which he wrote back in 2019, but all of the information was relevant in 2021, the beginning of 2021. So that was a really interesting write-up. And this time around, he released about 110 plus page write-up that was mostly covering the investment thesis for Nintendo and why he thinks it's going to be a multi-bagger going forward from here. Hey, I see a few people are joining the chat. How are y'all doing? If you can hear me, please let me know in the chat. I hope I'm not talking to nobody here. But back to the write-up that I was talking about. What was I saying? But yeah, he thinks it's a multi-bagger from here, which it's hard not to get excited about Nintendo. Based on this write-up, it's the most thorough. Maybe one of the most thorough write-ups I've seen on any company, it being over 100 pages. So if you if you have no clue what the investment thesis for Nintendo is, definitely go read that. I also did a video covering his first write-up a while back, around the time that I was considering making an investment in Nintendo. Oh, hey, Tim. How are you? How you doing? Tim, you're always on these chats, man. I really appreciate it. You must have the email notifications on. How are you doing this fine Saturday? I'm just talking about Nintendo as an investment. And I don't know if you saw Ryan O'Connor's write-up about Nintendo or if you have any interest in that company, but it's super thorough, and it really impresses me, and it makes me feel stupid as far as my prowess as an investor. But one thing's for sure is that Ryan has been super generous with his time in writing up this letter primarily for the investors in his fund, but at the same time, we get to piggyback on that and learn a ton about a company that almost every single person has heard of in Nintendo, but most people probably haven't considered it as an investment. So, and one interesting thing I'll just point out is that he writes at the beginning of the letter that he has about 25% of his assets under management in Nintendo. So hi Amid, how are you? Good night. It's afternoon for me. Hope you're settling in. Welcome. But yeah, he has a quarter of his portfolio, his assets in Nintendo, which is an incredibly concentrated position. And Ryan O'Connor's one of these guys who says that he is more interested in microcap and small cap situations, as is probably correct for a lot of managers who are not managing, hundreds of millions or billions of dollars. It's much harder at those levels. But he says that Nintendo is basically a Lollapalooza situation of that's too good to pass up. So, you know what? Let me see if I can get nobody might be interested in this, but I'll post a link to the write-up that he listed on his website here. Just for fun. It might take a little while to get through. Like I said, it's 100 pages. But certainly well worth your time if you're interested in learning more about the video game industry, or obviously Nintendo specifically. And it also gives you a little insight into how to think about, think differently in a differentiated way from what the general consensus might be. How long do I think it will take for the Nintendo thesis to develop? Well, one of the things that, after reading his O'Connor's update, it sounded like the thesis should have started, or maybe the market might have been more inclined to realize their transition to a less cyclical, more subscription-based type of steady revenue stream company compared to the past. That probably was interrupted by a lot of the supply chain issues that we've been seeing recently. But it's already underway, I think. But as far as predicting when the market might understand, I think we have to wait until we see the next iteration of the Switch, so they most recently last year released the OLED edition, which was an upgrade of the base Switch model, better battery life, bigger screen, an OLED screen instead of just a basic, I think, LED screen to the base Switch. And but that's going to bring in probably third-party support. Obviously, it's going to be hugely instrumental in the market saying, okay, Nintendo's actually serious. They're going to be able to sort of have a platform here to support their first-party games and to get a huge 30% cut of any third-party games that are online on their digital eShop. In addition to that, they have the Nintendo Switch Online subscription model that they're packaging in a lot of downloadable content for free, a lot of emulations of their older games that if you played video games growing up, then it's going to be an extreme nostalgia bomb for you. And if you're already subscribed to Nintendo Switch Online, you're probably going to upgrade to that more premium tier. That's going to continue to increase the average revenue per user by quite some margin. And O'Connor actually projects that the subscriptions from Nintendo Switch Online will actually, the value of that alone is going to be probably within the next 5 years is going to be more valuable than Nintendo is valued at today in the market. So I'd say give it 5 years, which is probably, 5 years. I try to go into any investment thinking, okay, it might take 5 years to do this. That's fine. But he lays out some valuation work that's pretty compelling at the end of that write-up. So definitely go check it out. Sorry, Tim, I hope that answered your question. Hey, Jordan. what stocks have I been really considering? I feel like there's a lot of opportunities out there right now. Yeah, the opportunity set always seems to fluctuate with how I'm feeling personally. So yeah, I think there's a lot of opportunities out there. Obviously, there are some companies in my portfolio that I'm definitely considering adding to, including Nintendo, which has been kind of a theme of this chat so far, and there's always the opportunity to add more to Alibaba, but I kind of have a substantial amount of my portfolio in Alibaba, so I might just hold off on that one. I think Nintendo is at the top of my list for possibly making a full-size bet, maybe a 20% bet in my portfolio, in all honesty. Now, that might just be some recency bias with reading Ryan O'Connor's most recent Nintendo write-up. It's very compelling to me. And it's also some bias because I want to be an investor. I am an investor in Nintendo, but I want to be... I think it's a company, a very Munger-esque company, and a very Nick Sleep style company where they do the right things every day. And sometimes even people don't understand that there's a lot of how do I say this, tactics that a lot of companies use to monetize certain parts of their software, such as mobile. Nintendo pretty much has been a flop on mobile so far, except for a few standout games. But Nintendo's not going to associate with any sort of casino-like behavior because their reputation is more important than anything. Besides their IP, the reputation of Nintendo is more important than anything. So they do everything. They take all precautions to maintain that. Anyway, okay, so Nintendo. Daily Journal is another company that I would really want in my portfolio. Can't say why it's not in there yet. I guess just I have not been making any moves in the portfolio. So yeah, so I'd say Nintendo and Daily Journal are at the top of my list. I'm also looking into a few other companies. One is called Cogstate, which is something that I saw Ian Castle is invested in. He is a pretty well known in the microcap investing space. Cogstate, they offer tests. So they have a direct-to-consumer business where they offer tests to help you detect potential signs of Alzheimer's disease, and they also the primary bulk of their revenues comes from working with in pharmaceutical trials where they provide their software to help participants in these trials detect the complications or the risks in their in the symptoms of Alzheimer's to see if things are getting better or not better, but if things are not getting worse, which is the primary goal of early detection. So yeah, those are a couple ideas that I have. Jack, what are your thoughts on Buffett diving into Hewlett-Packard? Feels great personally to have bought before the big man himself. Oh, congratulations, Jack. That's good. Hewlett-Packard sometimes shows up on a bunch of screens. It's never a company that I considered personally, but I think a lot of their metrics are just completely underrated, and it goes under the radar. I don't think HP has that name brand recognition that a lot of computer companies, obviously Apple, have. But yeah, you should feel good. I think Buffett, which I think this was a Buffett move. Buffett made this investment, not one of his two generals. But otherwise, I'm not too sure about the competitive landscape for HP, but I'm sure that they're right at the top. But yeah, I haven't looked too much into HP. Baba hold. Eric asks, Baba hold or DCA? Well, I'm holding, and I have been dollar cost averaging in as it has decreased. I can't tell you what to do there, but that's my experience has been. I made a sizable purchase at the beginning of my my investigation in Alibaba, and then I've been adding here and there along the way down. And so we're sitting down maybe 40%, something like that, but it's okay. No problem. Tim, what would I say is the intrinsic value of Nintendo? And what is the value of the SaaS business and daily journal? So the intrinsic value of Nintendo. Well, I think what I've been doing is relying pretty heavily on Ryan's thesis so far with Nintendo. That's why I haven't made it a huge percentage of my portfolio. So I don't want to be dishonest about my understanding of all the projections, because he lays out different scenarios in which are likely to happen. With Nintendo, it's more of, does this pass my BS filter? Do I think that this write-up actually makes sense? Do I think it can happen? But I would expect Nintendo to be able to at least double within 5 years in a base case scenario. And then as far as daily journal, Matthew Peterson has done a lot of great work. He's an investor that is kind of becoming more well-known in the value investing circles. Guy Spear has interviewed him, and Investing with Tom has interviewed Matthew Peterson as well. And he's a big investor in Seritage and Daily Journal. But the thing with Daily Journal is there's a lot of understated revenue because of the way that they recognize the revenue. So they have go live periods for their clients to basically set up these government entities with their legal software. But that go live period can be anywhere from 3 to 5 to 7 years in some cases, as far as I can tell. And they don't recognize the revenue until go live. So it could be up until 7 years before they recognize millions and millions of dollars of revenue that's not reported on the balance sheet. So I think Matthew Peterson puts it at somewhere around potentially $1 billion if you have a 10 times multiple on $100 million in annual revenue coming from go live setup, annual service fees, and I guess potentially there's other aspects of the business too, such as filing tickets, and you get fees for that and stuff like that. So the SaaS potentially $1 billion in the next 5 years or so. Hey Frank, good to see you, man. How do you think Buffett would invest a small sum of money? He has said he could achieve 50% returns. What would he do different? So as far as what would he do different today? Yeah, no problem, Tim. What would he do today compared to when he was actually back in the 50s? Well, what I don't think he would do is invest in cryptocurrencies or NFTs or anything of the sort. I think he would still be, might be more into a private equity situation, who knows, but it's a good question. I think that he would primarily still be looking at tiny companies. The greatest inefficiencies, if you have a superior analytical edge, which Buffett clearly would today, even still, that's where you have to look. Now, for the most part, I'm pretty sure you're right there with me, Frank, as far as that would be the hunting ground. Correct me if I'm wrong. Hi, Jay. Welcome. Yeah, that's always the struggle, to be honest. It's sort of asking myself, what would Buffett do? Well, he certainly would be in special situations, especially special situations in small companies. So yeah, I don't even think he would worry about long-term compounders either. It looks to me like there are plenty of opportunities to invest your money in microcaps that aren't necessarily long-term compounders. You can have a good business and an excellent return just because of the valuation in some of those companies. However, you might find a KPG, for instance, that's a great long-term compounder and is selling at a ridiculous price. So I know you have firsthand experience with that. Hi, Jay. Eyeing any net nets? One of the net nets that's kind of getting away from me is called Harbor Diversified. I was looking into it at about $2 per share. Actually, it was about $2.10 per share, and I said around $2 I would potentially make an investment in that company. I did a video on it a while back if you want to check out the investment thesis, but it wasn't quite a net, but it was the downside was basically capped at $2. So as far as I could tell, but now that's up in 245, 250 range. It's been a lesson. Sometimes don't sweat it over 10 cents, and maybe don't even sweat it over 50 cents difference from your desired entry point. But I'm still watching that one. It's possible that it'll go back down again, but yeah. Hey, Yugal. Should quality YouTubers like yourself and Frank, shout out to Frank, and thanks for calling us quality YouTubers, focus solely on quantitative insights akin to research from super investors? Why do we often limit us to DCF models? That's a really good question. That's kind of what Frank, I was just talking to Frank's question about. I think that I love the idea of investing in long-term compounders, but I think the true way to build wealth, but it also requires a lot more day-to-day involvement, is to check out more quantitative investments. Just as I was saying about Harbor Diversified, for instance, there was a theoretical floor. I mean, there's no guarantees in anything, but the theoretical floor was $2 per share. Plus, they had 2 years of operating cash flow that they were going to be able to potentially distribute to shareholders, and the potential to continue operations in some capacity. So, there's plenty of opportunities down there. I don't know. I wouldn't want to say I've overdosed on the high quality compounders, because it's certainly more tax efficient and it's certainly more time efficient, I think. But yeah, I think there's no, let me just say, you're right that we shouldn't just limit ourselves to opportunities that we can calculate the intrinsic value with the DCF only. Yeah. I'm certainly getting more and more interested in companies like that, for sure. Hey, Dark Knight. Which of the investing biases do I struggle with the most? That's a good question. I'd love to see everybody's responses in the chat about this question. This is great. Investing biases. Let me think about this. I am not, I mean, I'm as far from a perfect investor as anybody else. So, let me think about this. But in the meantime, please, everybody, let me hear your answers as well. Probably one thing that I definitely price anchoring. I was kind of just talking about that as well with the quantitative approach, which this Harbor Diversified was. That price anchoring is definitely more of a that can be an issue for me as well. You could potentially miss out on a great opportunity because it's 10 cents above, some downside price. Or, if I bought even a long-term compounders, that can be an issue as well. Let's see. One is, I don't know if it's an investing bias. Maybe it is, but it's a mental shortcut. Cloning is a mental shortcut to find ideas from great investors. And this is a habit that I'm trying to kick pretty hard, but the best approach for me with cloning investments is to try to reverse engineer if they're not explicit with the investment. For instance, Monish Pabrai bought Alibaba. Charlie Munger bought Alibaba. They weren't explicit with why they purchased it. So trying to reverse engineer why they think this company is worth the price of admission into their portfolio. But sometimes leaning too heavily on the fact that, say, Pabrai owns this company, so let me do some work, but let me not do as much work as I might need to feel comfortable, and kind of lean heavily on them. Not lean heavily on them, but use that as one sort of crutch, I guess you would say. So, yeah. So it's straddling that line between genuinely trying to understand the investment case and wanting to just shamelessly clone. I think it's in my human nature, at least, to want to be a little bit lazy on that front. So it's something that I'm trying to not do so much, we'll say. Hindsight bias, Tim says, should have bought more. Yeah. Yeah. Or hindsight bias, should have bought less. I certainly struggled with that. With Alibaba, I have, it's in my portfolio. I definitely like the company. I'm not upset that it's in my portfolio, but it was a mistake to enter at. There's no way around it. It was a mistake to enter at the prices that I entered. Over the long term, I think it'll be fine, but that's hindsight bias for you. Jay says to continue buying when the stock goes up. Yeah. That can be really hard, especially if you're trying to convince yourself that this is a really great company. The price keeps running up and it comes to a spot maybe that's more than fairly priced if you're talking about wonderful businesses that you might be willing to pay up for. Yeah, certainly hear you there. Good morning, after dinner investor. Are you just waking up? It's 3:00. How are you, Jason? DCA too fast. Yeah. Running a sorry, I thought you said DCF, but DCF, you can also DCF too fast as well, I think. But DCA too fast. Yeah, you have to have pretty high conviction for sure to dollar cost average into a company that continues to go down. Certainly, every drop in price makes you kind of reevaluate the decisions that you've made, and it always seems to be that the companies you invest in go down immediately. That's been my experience. Tim, you bought a lot around 225. I'm assuming you're talking about Alibaba. Yeah, I mean, when Munger makes a move, he's one of those investors that it's very hard not to just want to shamelessly clone. I don't think you can say that you didn't, consider him in your investment case, but I certainly did. And that's why I'm not too worried about it. It's just the opportunity cost of having bought it around the $200 mark and then, watching it get cut in half. I don't think is very appealing for anybody. Jamie says one of his biases is the temptation to move on to new opportunities as opposed to letting positions play out. Rereading Lynch's book, and he mentions that his average investment took 2 to 5 years to play out. Yeah, that's a wonderful thought. Yeah, I mean, if one of the great things about, I'm not assuming anybody here is a multimillionaire or, an investment banker or running their own fund potentially, but that's one of the great things about just being a smaller retail investor is that there is a ton of opportunity for us. I genuinely think so far has been my experience that there's always an opportunity for investment. And that can be to our detriment when we commit money to something and it goes down in price, even though we think that the long-term play is still going to be there. So I completely agree with you, Jamie. Guys, we're all the same. What can I say? We're all struggling with the same stuff. This is great. How often do I look at my portfolio? I've said this in the past that it generally correlates with how well I'm sleeping. So the better I'm sleeping, the less I look in my portfolio. And so, maybe genuinely I might look at 2 times a week, maybe. Sometimes there's just a habit because one thing I need to do, which is a good reminder, Dark Knight, is I have my stocks on the whatever that page is on the iPhone. When you scroll, I have the stocks widget on there, which is a mistake because then you can get into the habit of, even though I'm not going to my portfolio, I might switch over to that widget and then see the prices of my stocks, and it doesn't really matter, and yada yada yada. But then I want to go check how much money's in my account and all that. So, yeah, sometimes I can go, I go a week without even thinking about it, but sometimes I'll be a little bit more neurotic, check it daily, more than daily. So it really depends. But I think the ideal thing is to monitor it very sparingly, I'll say. Buenos dias. Buenos dias. Yeah, opportunity cost is real for sure. Yep. One thing I did like about opportunity cost that Charlie Munger said, which made me feel kind of good at the Daily Journal meeting, this, whatever that was last month. Somebody asked if he ever had a huge cash pile sitting around. And his answer was that no, he's always just tried to make the most of the opportunity set that was in front of him and try to deploy that cash as intelligently as he could. Basically saying that he didn't really hold significant amounts of cash, which is kind of the sentiment that I've been going forward with. So you got to put yourself in the position to have success, but the downside is that the opportunity cost, if the position goes against you, yeah, certainly can be a backfire. ADI asks, what's catching my eye? What are some stocks you're looking at and possibly wanting to buy? I saw Cliff Sosin bought more Party City. I'm looking into it this weekend. Interesting. Where are you checking out Cliff Sosin's portfolio moves? Does he post that on Twitter? Does he tracked on Dataroma or Ticker maybe? But that's interesting. His portfolio from the positions that I think he has, he has a big position in Carvana. So Party City, that's puzzling. Please do let me know what you figure out if you talk about it in one of your after tea or your after dinner tea times. I'll certainly watch that episode. Yeah, off the bat, Party City sounds like not a no-brainer, I'll say. But maybe the business has changed. So, but I did talk about this a little bit earlier. I was talking about some companies that I'm looking at are Nintendo, Daily Journal, and Cogstate. So if you want to kind of rewind a little bit closer to the beginning of the video, you can hear some of my thoughts on those. But they're all Nintendo is one of the most well-known companies in the world. And then the other two are much smaller and probably not very well known outside of microcap and small cap investing. So, was there one more that I was looking at? No, that's kind of what's on my plate right now, I think. Yeah. Yugal asks, do I feel the urge to sell out of Alibaba at 225 after it recovers and get the relief? Yeah, no. Well, yes. Let me say that thought has certainly crossed my mind. And I think that would probably be the worst, besides selling it when the portfolio is down 50%. That might also be one of the worst times to sell. So we'll see when we get there, but I don't think I will. One thing I may do is reduce my exposure a little bit, not completely sell out. But some things have to go really right for the business or for the regulatory environment or the relationship between the United States and China. All these things that are superficially affecting potentially the stock price. It's on both the business and the environment, and that can, maybe when that time comes around, I may want to reduce exposure, let's say. But thought has certainly crossed my mind. Relief is it's always once you get back to we can call it your high watermark of your initial investment price. And then at that point, you potentially have dollar cost average on the way down if you think it's a good investment. So you might make some money on the way back up. Make the time where the stock price is down there a little more favorable for you. So yeah, good question, you all. Curious if anybody else has those thoughts, because Tim answers, yeah, going to hold BABA for a long time. I know the thesis is good over the next 10 years, if not sooner. Yeah, I mean, I agree. I'm sure I'll have Alibaba in my portfolio for quite some time, but maybe not the full position that I have right now. We'll see. Jamie, a lot of people seem to be struggling with BABA. Has there been a position you held that was particularly rocky to endure that stands out to you? Besides Alibaba, no. In all seriously, Alibaba, yeah, it's gone down quite a bit. A lot of value investors who follow Monish Pabrai or Charlie Munger or whoever have seen their positions hit pretty hard. But it's not something that really keeps me up at night, to be honest, because as Tim mentioned earlier, I think the thesis over 10 years is really where we've got to be thinking for this. So let me think. In the past, yeah, Fiat Chrysler is a company that comes to mind. Back when I first learned about Monish Pabrai, he still had a pretty big position in Fiat Chrysler, and I did a little bit of research, but as I was saying before, I still had I was pretty new to cloning, and it was more of a shameless clone than a reverse engineer type of investment. And believe it or not, Pabrai was already way up on that position, and I entered at a spot that it had just come down a little bit, but it continued to fall once again. And then I held it through COVID. It fell again. Fortunately, during that period, I held it, and it went back up. So there were quite a few mountainous swings with Fiat Chrysler that were not so fun, let's say. Especially because it was one of these companies that, I mean, I understood the investment thesis, but I was no Monish Pabrai in my level of understanding of that company. So that was one thing. It's one of those where if your conviction isn't necessarily where it needs to be, then it makes the journey of holding these companies a lot harder. So yeah, that I've learned a lot from the Fiat Chrysler position, where you might get burned, but I didn't. Fortunately, in the end, I did not get burned. I didn't lose money, but just yeah. ADI, Open Insider SEC Form 4. He owns more than 10% of Party City. Okay, that's wild. But Cliff Zosen, man, I'm not really sure of his returns or anything, but he's definitely an investor to follow. So looking forward to what you can find out about that. How do I balance reading books about investing versus spending time actually looking at companies? I felt I was looking at too many mediocre companies, and I'm now trying to do more reading. Well, that's a good question. I think maybe my last video I was talking about, and I think you've written an article about this too, about what Munger basically coins as selling yourself the best hour of the day. So making sure that first thing in the morning, dedicating an hour to the investing practice. So one of the things that I love to do is book, general news, whatever. I've got a ton more stupid investing books here, None of those are going to take me to the promised land. So I'm kind of in the exact opposite position of you, where I felt that I wasn't doing enough reading about actual companies. So now I'm selling myself the first 30 minutes to an hour every morning reading investment write-ups or reading, direct financial reports. So that's where I've been really getting a lot of my interest from these companies that I mentioned. Daily Journal was reading through their 10Ks, Nintendo reading through their reports and Ryan O'Connor's recent write-up, and Cogstate reading through their letters to shareholders and stuff too. So learning a lot about the business, and you can really tell the difference between dedicating a lot more time to reading these primary sources, for instance, you can really tell what managers care about their businesses and which managers do not care. That's really enlightening. And yeah, that's kind of my piece on that. F asks, what do you think about investing in IPOs? I've never done it. I don't think there's, I don't know if I have an advantage there necessarily. And I mean, Weschler and Combs at Berkshire Hathaway are investing in IPOs. They invested in Stone. They invested in Snowflake. It doesn't seem to be off limits to people that Buffett is willing to impart all of the trust that he's built with Berkshire Hathaway over these years to some investors that are willing to invest in IPOs. So, but they have a lot more time to dedicate to learning about these companies pre-IPO and all this. It's probably just not something that I'm going to be an expert in. I'd rather look at a company where maybe not a lot of people are looking at it. And IPOs are kind of the opposite. ADI, and we'll just let opportunities come to me more. And with more investing knowledge, I'll know when to jump on them. Yeah, definitely. Absolutely. Hey, Quant Compounder, what's good with you? Yeah, I mean, as Pabrai paints this picture of his day where basically he's just reading annual reports or doing general reading, but primarily it seems like somebody might recommend a company to him. And if that's an interesting opportunity, then he'll go all in on studying that specific opportunity. Otherwise, he's probably doing more general reading, maybe just more searching. And I think that's a fine approach from what I can tell. Some ideas you might come across somebody's write-up and say, I need to put this in my portfolio. And sometimes ideas just click, So I totally agree with you there. And I remember you were tweeting about this, or maybe you were talking about it in a live stream, Jason, but when Buffett was buying back Berkshire stock recently, that's one of those ideas that after having more experience thinking about the way that Warren Buffett actually operates, would have been a good time potentially to at least investigate Berkshire Hathaway a little further. And Jay mentions both are important. Just keep switching between probably general reading and thinking about reading primary sources for specific companies, which I agree. I mean, I think you need both. But some of the times I'm reading business news when I know that there's an idea that I'm interested in, and I'm just kicking the can down the road for lack of a better term. I mean, learning new ideas just in case reading is really alluring. Reading about management of specific companies, for instance, that might be helpful. Just in time information is also very relevant. So if there's an opportunity that you're excited about, I think it's good to switch it into high gear about those specific companies. But otherwise, yeah. Yugal, what percentage of your net worth are you invested into the market minus the house? Do you feel comfortable? Any insights from super investors? So let's see. Percentage of my net worth besides the house is shockingly high. I do through work. I have investment in the S&P, but I have a small, emergency. I have my emergency fund and savings for life events. I'm getting married this year, so got to be saving for that. But otherwise, everything is basically in the market. So 80% maybe of my net worth besides the house. It gets less with the mortgage. But yeah, I want to be as invested as I can without sacrificing any, it's foolish in my opinion for me to not have some sort of cash buffer because of life events and things like that, But I don't know if that's extreme or not. I mean, I don't know if you guys have feedback about that, but that's just kind of the way I'm rolling right now. I'm always trying to have as much money. I try to pay myself first, so put money into my brokerage account first before buying things. And, hopefully I can afford groceries after that. No. Tim asks, I'm trying to get more okay with reading a 10K, 10Q, 13F, 4F each day. At first it was incredibly boring, but it is getting a little easier. Maybe by the end of this year, I might actually enjoy it. Yeah, that's a good point. And as I was mentioning earlier, you can kind of tell if you're bored by reading an annual report, either the management isn't displaying any kind of, the 10K, maybe if you're reading the shareholder letter, you can really tell about management's enthusiasm for the business and how much they care about the shareholders through those. But if you're bored by reading a 10K, or if I'm bored by reading a 10K, then that's probably a sign that I don't really care about this business and I may want to move on. So I totally understand. And that's the thing, 99% of the businesses you either aren't going to care or aren't going to understand. And so that naturally is going to lead to boredom when reading. But for instance, when I was reading the Daily Journal, that was super exciting for me. But trying to read some financial statement for a bank or some 10K for a bank is very not so exciting. So I feel you totally. But yeah, with repetition, you learn to love just putting more information into your brain. There's a part of that. But yeah, absolutely keep working at it. I'm right there with you, Tim. Jay, SNBR. I'm assuming that's a ticker. Let me see if I've got. I'm pulling up SNBR. Let me see if I can share this sleep number. Oh, okay. Where's my? Let me get the little display capture. Do I have that going? Hello. That's not what I want. Show screen. That's what I want. Okay. Sorry, guys. Bear with me. Trying to get this sleep number. There we go. Okay. Perfect. Can everybody see this? Yeah, I guess it's fine. Sleep Number. Yeah, I don't know anything about this company. I mean, I've heard of Sleep Number for sure. Offers individualized mattress and sleep solutions. Yeah, so they sell beds basically. Direct to consumer and online sales and wholesale. Okay. Small value. Okay. The key ratios on Morningstar guys is incredible. They're selling at a pretty ridiculously low multiple to their free cash flow, depending on the steadiness of their earnings historically. Wow, this is pretty impressive. The revenue growth, even straight through the pandemic. What's this bump? I mean, why? Their operating margins are pretty good for retail, as far as I can tell. Very steady in the low 60s. But wow, this is really impressive, these free cash flow numbers. The last thing I would check is probably the balance sheet to see how they're capitalized. If they've got a bunch of debt, then that's kind of scary, but at the same time, it's not the end of the world. Don't have a lot of cash. Most of their current assets are in their inventory, which, okay, they sell mattresses. Short-term debt could be serviced maybe in 2 years of free cash flow. Okay. I mean, yeah. So that's a cool idea. I like the look of the revenue growth and the free cash flow growth for sure. Yeah, I would only be a little bit concerned because it seems they're retail, but that's all the insight I have to offer for you there, Jay. But I appreciate you sharing that idea because that's something that I'll look into, because over the past 10 years, it's been very steady revenue growth, very steady very steady margins just staying the same, which for a company that continues to grow, especially in that space, you might expect to see that the margins are declining as revenue grows. So they're not spending too much on, too much to acquire new customers, I guess you could say. And the free cash flow. Retail company with selling at 5 times free cash flow or something like that. Look at the buyback. Oh, shoot. Look at the buyback. Yeah, good call. Yeah, shares are they had 52 million shares outstanding in 2015. Now they have 25 million. That is incredible. Okay. Yeah. Huh. Okay. Thanks, Jay. That's impressive. Thank you. All right, I'm gonna probably touch on these questions that are in the chat, and then probably wrap it up. I was supposed to be going for 30 minutes. Ended up at 50 here, but this is a good chat, and might have all been worth it for the the sleep number. Appreciate it. Yugal asks, what book do you reference the most when analyzing a stock? Which book has been the most helpful? I think I would say maybe the Warren Buffett Way has been an incredible resource. It's a pretty simple book, but I think it's a complete package as far as understanding how to value businesses at a pretty reasonable level. So I would say Warren Buffett Way and Poor Charlie's Almanac. So you got the 1-2 punch of more of a down-to-earth approach to thinking about actual businesses, and then we've got managing all these biases and stuff that we've been talking about through this whole live stream. So it's, those are the two. And Poor Charlie's Almanac might be a cliche, but it's a cliche for a reason. It's incredible. Jamie, you focus a lot on reading, watching counter arguments for investments you're considering. It is surprisingly easy to talk yourself into an argument. It's a bit more difficult to defend your thinking. Yeah. One of the benefits of maybe having this online presence with YouTube, or maybe some people are on Twitter, is if you put an idea out there, you have to articulate it in a way that at least you can teach it to somebody else. Otherwise, what's the point? So you get to a certain base level of understanding, and that really helps me convince myself that at least I'm not BSing myself. There is something here, but then there's usually a lot of great feedback in the comments. So yeah, that's one of the pros of actually having this channel is that getting pushback from outsiders about how you're thinking about a business. Or one of the things that can get troubling is if people pile in and say yes, it's a good idea. That's a good idea. So that's totally true. Yeah, and that's one of the things I was talking about with cloning, is you can kind of get yourself into a little bit of trouble if you can talk yourself into saying, okay, Monish Prabhai bought this, then I'll look at the company and convince myself that it's good. But that can be dangerous. Quant Compounder. I think annual reports and quarterlies can be quite overwhelming at first, but there are key areas to focus on where you can get a real grasp of the key points, in your opinion. Management discussions, risk factors. Yeah, absolutely. Overviews of the business are really useful, especially if you have an understanding about a little bit about maybe the product that you're looking at or something. But if you dive into, say, an Apple 10K, there's no way you're getting through an Apple 10K in one day. Yeah, might take a week to get through one, and especially that's fine. We have the luxury of, especially if you run a concentrated portfolio, the luxury of spending a lot of time on a very select few ideas. So, but I absolutely agree. You kind of do have to ease your way into them a little bit. That's why write-ups are so nice. It gives you a primer, and then you go into the 10K having some understanding of what the business does. Then you know how the management is actually portraying this business compared to the write-up, and things like that. So, hey, Benjamin, what do you think about Wix now? Yeah, I've been thinking a lot about where I was thinking a lot about Wix, and I kind of put it in my too hard pile. I know Rob Vinall has a sizable position. I know that Pat Dorsey has a sizable position, but that's not enough for me to get over the hump of just not being excited about the business. You know, that's just kind of where I'm at with that. I'm sure it's I'm sure I'm wrong, but I'm just not going to go there. Yeah, I mean, I think somebody posted a comment saying that the moat. Let me try to remember this. Thinking about a moat for Wix is kind of silly because most of their customers are small business owners, and the majority of small business owners go out of business. And I thought, well, that's kind of true. But then there are always new small business owners probably to replace them. My biggest hang up with Wix, and it's probably because I don't understand the product well enough, which is a sign that I shouldn't be investing in it, is 10 years down the line, why is Wix going to have a super differentiated product from Squarespace? You know, or Shopify. And I understand that there can be room for all three. It just seems a little bit too hard for me to predict. Yeah. Quant compounder. SNBR been on Magic Formula for some time. Okay, so has HP, DKS, and Medi. All compelling, I think. Okay, yeah. I mean, it's hard to go wrong with paying a lot of attention to the Magic Formula. That's actually a website I haven't been on in quite some time, but that I need to take a look at that. But I'm super impressed with the sleep number. That was pretty wild. Let me look at what's that? Oh yeah, HP real quick, just for fun. Let's see if it'll give it to me. Nope. Okay. No, come on. My computer. My internet, perhaps. So HP, I mean, look at this monstrous free cash flow. What are they valued? What's their market cap? 40 billion. Okay. They're buying back shares pretty steadily as well, which is good to see. Their margins have actually improved recently, and I'd be very curious. They went down quite a bit during these pandemic years, but that was a trend seemingly happening before that. So what did management do to turn this around here? The revenue numbers back in the beginning of this decade were quite astounding, and they seem to be rebounding. I don't know if this is a cyclical type of situation, but I'm liking what I'm seeing from this as well. So yeah, as we know, so if this is on the Magic Formula, it's being classified as a good business or a great business at a good price. So yeah. What does this look like? Okay, it's not too shocking, not too alarming or anything. They've got a decent cash position, actually. They probably wouldn't have any trouble paying off any debt, but they have some debt, but maybe 1 year's of cash flow is worth, so that's not too scary. I don't like debt, but if they're financing this new growth with debt, it's not too bad if they're able to pay it back pretty quickly. Anyway. Okay, everybody. I think that is it for me. I really appreciate you all hanging out this fine Saturday afternoon. I'm probably gonna go play some Elden Ring, If anybody is into gaming, that's a game that has been distracting me from a lot of other things in life. I've been playing Elden Ring, and I've been watching The Sopranos, which is consuming all of my free time that's outside of work, family, and investing. So 2 wonderful, wonderful outlets, though, I must say. Yeah, Tim, I appreciate you being here. Thanks for the great questions. Thanks for all the food for thought for me, and sharing your insights and experiences as well. It's been a blast. Yeah, thanks for all the great questions, everybody. Yeah, my pleasure, Quant. Thanks for joining. Great, Jamie. Well, you asked some wonderful questions, so you're a big help in this. So, but I'm glad you find them informative. Appreciate it. Alrighty. I will see you all soon. I'll be posting a video sometime at some point. Happy investing, happy hunting. Appreciate everybody's support, and I'll see you